Welcome to Raising the Curve, a podcast designed to teach you everything that you need to know to be better with your money. Come and learn alongside me, Sophie, a total beginner from the finance expert, Victoria Harris.
So I've asked all of the questions you wish you could so that finance, investing and growing your wealth actually makes sense.
Yes, it's expert education, but that we promise will not be boring.
And in the wise words of Cher,
my mom said to me, you know, sweetheart, one day you should settle down and marry a rich man. And I said, Mom, I am a rich man.
Come and talk and learn and laugh with us because together we really can raise the curve. So last August, we released an episode called...
Last August?
I know.
Wow. God, time flies. I'm having fun, girl.
It was like a Raising the Curve 70-something. When I was looking at it, I was shocked at how old it was.
Yeah.
Really didn't feel like that long ago. It was my grandma left behind $1 million portfolio. And with the world's biggest investing club starting to really ramp up in terms of behind the scenes, we thought in the last year there must be a lot of people who have found this podcast and didn't listen to that episode. So we wanted to do a little remake. This is like the Curve Archives episode. We had so many cool messages when we released this episode from people saying, oh my God, I really want an investing club.
And also how amazing your grandma was to be doing that 50 years ago.
Don't give it away for people who haven't listened.
Sorry.
But yes, we're going to go into that episode again in a second. It was really what sparked us to think there's definitely something in this. Like if there's that many people messaging us saying, oh my gosh, that was so cool that your grandma did that.
Yeah, and like all our guy friends had WhatsApp groups and like Reddit groups where they would talk about investing and stuff, and none of our girlfriends did. And I was like, why not? Let's create something. And maybe it's because there's nothing cool out there that resonates with them. So we're like, let's do something.
Let's go to this episode. If you have listened, maybe listen again.
Yeah.
If you haven't, definitely listen, because this is, I felt very proud to talk about this, release this episode.
We've got an update on the world's biggest investing club, don't we?
Yes. You're going to have to listen to the end of the episode.
Yeah, we'll do it at the end.
Or if you have listened to this before and you just want to jump to the end, fine. My grandma, she was very amazing. And I feel like it's only really since she died that I've started to learn more about her. And the more that I've learned, the more I've been impressed with the stuff that she did throughout her life. So we were going through all her like beautiful antique clothing, and we found her knitting needles, and we found her Spanish cassettes because she was learning Spanish.
When did she pass away?
Well, I was 18, 19, 20. Yeah, so it was 14 years ago.
Yeah.
Quite a while.
Yeah,
so she used to learn Spanish in her spare time. I mean, just even doing that is quite incredible. And she worked in the MI5 or MI6. I can't remember which one
Which is like the spy unit of like the UK or something.
Yeah,
it's like crazy.
So cool. So anyway, they met when they were over here in the UK. She worked as a secretary in the MI5 or MI6. Really need to get that right.
That just reminds me of like some movie like Inception or like The Bodyguard.
Oh, It's so cool. And then my granddad worked as a doctor during the war. So this is Second World War. Anyway, they migrated to New Zealand and then she started having kids. So they would have been early 30s, and that's super late to be having kids when you're back in the day, because this was like, 80 years ago. Anyway, one of the things that she did throughout her life was invest. So she invested for, I think it was about 50 years in the end. And I've only just sort of recently come to know this because when my granddad died, my dad inherited the investment portfolio.
Yeah.
And so this was something that was, when Dibby died, the investment portfolio moved to be under his name.
Yeah.
And then when he died, it's been moved to be under my dad and my uncle's name.
And you're like, Dad, can you leave it to me, please? When it's just generation to generation.
I mean, bless Dad. He's like, no, I'm leaving it in there, of course. Why would I take it out? And I'm like, oh, you're such a genius. But I don't know. I feel this weird serendipity, like connection to her now that I know that she was this massive pioneer when it comes to investing. So she had an investing club with her female friends.
Which even that back in the day is like wild. The fact that she could even find some friends that were interested in investing and doing it, like she had that initiative and then did it on a regular basis is just like
so cool. So they met, I think, once a month, and there was a bunch of women and they would sit down and have tea and scones and talk about companies they wanted to invest in.
Yeah.
So cool. They invested I don't actually know how much. She was given a lump sum of money from her family. And with that, she was allowed to do with it what she wanted. So rather than buying stockings and makeup and all the things that going on holiday, whatever, she decided to invest.
Go her.
Go Dibby. And so my granddad.
And just for context, like this is a time in the stock market is pretty bloody scary. Like you've had the Great Depression, like the 1929, stock market crash, which caused the Great Depression, but like scared a lot of people out of investing. This is the time when it's post-war. It's not the most stable economic time to be investing, but go her.
Anyway, so my granddad, he would pay for the house, he would pay for food, he would do all the basics and necessities, and then she was allowed to do what she wanted with that money. So
this is money that she earned, so she kind of invested the money.
Well, I don't know if it wasn't just the money she earned because she wasn't working when she came to New Zealand.
That's right, yeah.
But it was, yes, I guess what she'd accumulated from working at MI6, MI5, and also the amount that she was given from her parents is kind of like not a dowry, but here's some money to help you in New Zealand kind of thing.
Yeah.
And luckily my granddad was, because he was a doctor and a surgeon, he was able to pay for the necessities.
Yeah.
So she had the opportunity to do what she wanted with that money.
Yeah.
But rather than just splashing it on things, the fact that she was researching companies, going to an investing club, and then actually investing blows my mind.
Kept it in there for 50 years. Like, that's nuts. That's crazy.
So she didn't pull that money out. So she basically has invested, and that money has grown now to be $1 million.
Yeah.
And she's passed that on. It's like
And it started at about $12,000, wasn't it?
Oh, it's just like.
Which is 50 years ago would have been a lot of money anyway.
Totally.
Going from 12,000 to $1 million. Like, that's wild.
Yeah.
But over 50 years, it's so doable. But it's just a lot of us do not keep our money in for that long. We grow a little bit, maybe 10 years. We're like, oh, okay, we'll take it out now. I'm going to go spend it because it's grown. So, yeah, quite amazing.
Oh, it's just so cool. I feel very proud and grateful because that's going to change my dad's retirement. That's going to change my uncle's. Sorry, we've got to start calling it the 20-year holiday.
Yeah. We're rebranding retirement.
We're rebranding retirement. But that's going to make such a difference for them,
Totally.
Like the amount of financial pressure that's going to take off of them is huge.
And I love that your dad's like, I want to try my hardest to not touch it so that he can pass that on. I would love to be able to pass on money. Yes, I'm saving for my own retirement, but if I get to a point where there's money in there that I don't spend, I would love to leave it for my children, my children's children. It's kind of like a legacy. And how cool would it be if my grandkids were sitting on a couch talking about my investment portfolio? I'd be stoked. So I had a look at the portfolio. So I've sent it to me and I've got a few takeaways.
Yeah, we were going to go through it. We just thought we owe it to her to give her a bit of airtime for what she invested in, learn from how she did it. She obviously had some that didn't go particularly well and some that went really well. But we just want to look at it as inspiration because I think, just firstly, the fact that she was investing at a time we had to look at stocks in the newspaper, right?
And this was a time when there wasn't pretty much like any woman in the finance industry. The first lady on the New York Stock Exchange was 50 years ago. So like if you think there's very few women now, imagine what it was like 50 years ago.
I really want to.
I imagine like the criticism she would have got when she's like, I'm doing an investing club, I'm investing that money. Like, like I can just imagine not the stigma, but the judgment or, what do you mean you're investing? That kind of thing would have been so fascinating back then.
I wonder how many people she spoke to about it. I wonder if she was quite open and talked to everyone or if she kind of kept it.
Or the number of people that were like, oh, you should take it out now. You should take it out now. The market's going to fall. There would have been so many people in her ear and she would be like, nope, I'm going to keep it in there. I'm going to keep it in there for my grandkids.
I'm so proud. I'm so proud.
Anyway, I want to talk about how well it's done because it's all well and good investing for the long term, but I want to kind of tell people why. And so she started with about $12,000 50 years ago, and now it's at $1 million. So if we broke that down, kind of the average return per year, it's just over 9% return per year, which is amazing. Like to get that as an average, considering all the market corrections and falls that we've had over that time. We've had the global financial crisis. We've had the dot-com, which was in 2000, which was when all the internet companies blew up. Like there's been so many blow-ups in the stock market, yet she's still managed to deliver over 9% return.
That's amazing.
Yeah. And the stock market, I calculated versus what the stock market's done, the US stock market, and that's only done 8%. It was just under 8%.
So she bet the market.
She bet the market.
Oh my God.
Yeah.
She's so cool.
Which is quite amazing. Yeah. And I remember speaking to your dad, and he was like, she definitely had some blow-ups in there as well herself.
Yeah.
So to think that, this is a return considering she's had some pretty bad investments in there, which is kind of comes to my first point, which is one of the 4 takeaways that I have, is that I think the reason it's done so well over the long term is because it is so diversified. Those few bad investments that she had in those finance companies in New Zealand didn't make a huge impact because
what are finance? Sorry, just quickly. What are the finance companies?
So back in the global financial crisis, there was like companies that you would invest in that were then lending your money out to projects and things that they had self-interest in, if that makes sense. So a real simple example, it's like, hey, I've got this company, invest in my company, and I invest in this property, for example, but really I'm the investor in I'm also the owner of the property, so I benefit. So it was just like all this kind of intertwined, muddied kind of conflicts of interest, and it was borderline illegal, but that's kind of, and they all unraveled and blew up, and then that.
So she'd invested in a few of those?
Yeah. So there was.
Because I do remember my dad saying, I don't remember what the companies were called, but I remember my dad saying that she did make a few bad investments and lost quite a lot of money.
Yeah. And that was in New Zealand. And then in the US, there was all the companies, the banks and finance companies, they were giving out dodgy mortgages. And so then people couldn't pay their mortgage. And then that led to kind of the downfall of Lehman Brothers and stuff, which you may have heard of, big investment banks over there, which kind of filtered through the finance industry and the economy.
So she made some bad decisions, but she also made some good ones. And are we basically saying that because the reality of investing is that you're
going to have a bad investment.
There's going to be stuff you invest in
I've
that
had
does
bad ones.
badly.
I'm still going to have bad ones. But this is why if you can spread your risk by investing in a lot of different companies, when one does blow up, that's not your life savings. That's 10% or 1% or whatever of your money. So you're like, you know what? That's fine, move on, invest in something else, because there will be, you never know what's going to happen in the world. So yes, she invested in 25 different companies. So quite diversified.
A lot.
Yeah. So it sounds like a lot, but
no, I mean, I'm impressed by that number is what I mean.
Yeah.
Because the amount of research she would have had to do with no access to Google.
Totally. She would have been reading the paper to find out the end of the day share prices. Like that's back in the day.
I can just imagine her with like a highlighter and a pen and her glasses writing down all these notes and sharing it with her friends.
I had a boss, bless his heart, who would check the newspaper for the share prices at the end of the day. And I'm like, you realize we have it on the computer minute by minute. But he was just such an old school mentality way of investing. So it was quite funny. But yes, that the way that you even used to trade, you didn't have a Sharesies. You couldn't just type in, I want to buy this company and it automatically happens. Back then, you literally had to write out a letter, post it, but would take days to get to the broker or whoever was doing the transaction.
Oh my God.
And then they'd post it back. Yeah, it was wild. And then it moved to email, when you'd email your order, and then now you can just do it instantaneously. But those 25 companies, it wasn't just investing in 25 different companies. They were in different countries. So she'd invested in the UK, Australia, and New Zealand, and the US. She'd invested in different sectors. So she's diversifying across different sectors. So banks, resources like, oil and gas companies, for example, media companies, utility companies, which is like power and electricity.
Oh my God.
Retail companies. So, supermarkets, shopping malls, and telecommunications companies, which is like, your Vodafones and those kind of things. So
she did everything that you tell us to do.
And she invested in different sized companies as well.
Go Divi.
Yeah. So she invested in Disney, which is, 160 billion.
That's crazy to me that she could invest in Disney that long ago.
Yeah. Walt Disney has been around for a while, but we know it as Disney Plus. But Walt Disney has actually been around.
So her shares with being Disney Plus now?
No, it's the same company, but we view it as Disney Plus, but it's Walt Disney has been around forever. Anyway, and she also had different investing strategies, which was quite interesting. So she had some active investments and some passive. And by that, I mean, she had literally stock picked which companies she wants to invest in. So Disney and Telstra and Woolworths in Australia, etc. But then she'd also had some passive investments, which means that she was investing in an ETF. So she was just investing in the stock market. So she's kind of like, look, I want the market return, but I also want to invest in some companies that I like or that I think are doing well, which is fine. You don't have to be exclusively one or the other.
I do that. I do that.
Yeah. Sometimes you're like, oh, you know what? I can't be bothered researching a company. I just want to invest in the stock market. And it's like, you know what? I'd rather that you just invested in the index or an ETF and did it that way than sitting there worried about what you're going to invest in and not actually doing it. So so she had great diversification from that standpoint.
It's crazy to think she did the active in terms of found stocks and companies that she wanted to invest in specifically, and that she did passive, using ETFs. I mean, has there always been ETFs? Or is that a reasonably new phenomenon?
Good question. No, it's not that new.
Yeah.
But this one, the NZX 50 is what she invested in. Which is the top 50 companies in New Zealand.
Yes.
So, the New Zealand stock market hasn't been around for that long. But yeah, I think ETFs have been around for a while.
I can't believe how good her portfolio is. Like when Dad sent it to me, I was like, I'm going to forward this straight to Vic.
Vic, look at this.
What does it mean?
What are all these numbers? Yeah. So anyway, and then the second thing is that she invested in a lot of boring companies. But this is good. Like if you're investing 50 years, you want to be investing in the boring ones. You want to be investing in the tortoises, not the hares. You want to be investing in those slow, steady, sustainable growers because that's what's going to deliver over the long term. You don't want to invest in those ones that are up 100%, down 100%, those really, really spicy ones. But this is also a favorite strategy of Warren Buffett's. He invests in the most boring companies, like honestly, like insurance companies, FMCG, like fast-moving consumer goods, like food companies, banks. Like he invests similarly to your grandma. Ooh. Yeah, are you calling my grandma Warren Buffett?
Yeah, I'm like, I feel kind of emotional.
Yeah, so
how cool is this?
It's boring companies are good because they're the companies that we use on a regular basis, and they're the companies that we're going to continue to use no matter what the economic environment. They're the ones.
No, you changed my mind.
Yeah,
the fact that she invested like that makes me think I've been up until this point pretty bitchy about the tortoise companies, the slower moving companies.
Because they're not exciting. And when you go to a dinner party, you don't want to be like, I invest in this bank. And you want to be talking about, yes, I invested in Meta.
As
and
if
it's up
you
100.
talk about that at a dinner party.
I know, but that's what I mean. That's the whole annoying thing about investing in the stock market is everyone likes to talk up these amazing, fascinating companies they've found.
Trust me, most normal people are not doing that.
I would rather sit in the corner and be like, you know what? I'm investing in the slow and steady ones and I'm just accumulating my wealth and I don't need to toot my own trumpet about it. Yeah. Anyway, that's what
You want the Dibbies approach.
Yes, you want the Dibbies approach. So anyway, boring companies have usually pretty strong balance sheets so they can survive through 50 years of economic turbulence. They've got really good profits. They've been around for ages, so they pay good dividends. So she was reinvesting those dividends as well, which is really, really good. Yeah.
I'm sorry. Is she not the coolest person ever? Do you not look at that and think, you are so clever? Because, right, who would have told her to put the dividends back in? Most people would be like, I got dividends. I'm going to take some of that out.
Yes.
So she was so a lot of those companies, the more boring standard ones, do give dividends, right? Because they can afford to, they can see what they're earning.
They've been around forever. Their revenue and their profits aren't going up and down. So with
that, because she chose some of those companies, they pay out part of the return each year. And she was putting that straight back into her investment portfolio.
Yeah. So, which is quite wild. And so, a lot of these companies like Contact Energy, which a lot of New Zealanders will know, Mercury Energy, Fisher & Paykel Healthcare, Telstra, Chorus, this is really, really diversified portfolio. So there's a lot of spread amongst different sectors, but they're all pretty boring companies. They're companies kind of like behind the scenes. You use them all the time, but they're not the big flashy ones that you see up on billboards or like all that kind of stuff. So, and she also did a lot of investing in what which is something we've harped on about at The Curve, is that, she invested in Woolworths. We all know what Woolworths is, it's a supermarket chain. Telstra, CBA, which is like the one, if you're in Australia, you know what that is. It's one of the biggest banks in Australia, Commonwealth Bank.
Oh, is that CBA?
Yeah.
Ah.
Sorry.
No,
I was
that's
just throwing the ticker there. The ticker code.
I'm following.
And Contact Energy, if you're in New Zealand, you know that's a company that's been around forever. A lot of us have our power and electricity with Contact. So it's these companies that you know and you see all the time.
Well, she was also a housewife, essentially. Yeah. So she knew probably, what the power was. Yep. She probably did the groceries. Exactly. She invested in things that were existing within her world and that she understood, which is what you always talk about.
Totally, yeah. And that's exactly what Warren Buffett does. I remember he came out and he was like, I'm not going to invest in tech companies because I don't understand them. I'm going to stick to what I know and invest in. And then that's why when he invested in Apple, it was like, whoa, you said you weren't going to invest in tech companies. He was like, it's a consumer company. I use their products. I understand it. And it's so getting that mentality. You can get so stressed and worked up about trying to invest in something that's like a cryptocurrency company or, you know, something that's like so hard to understand. It's like, just don't even bother.
Yeah.
Put it to the side. Move on. There's so many other things you invest in. Yes, but she reinvested her dividends, which is great. And this can actually lead to a really significant portion of your returns. So we've spoken before about compound interest. Dividends is just like the interest effectively. So if you're reinvesting that back in, you're starting from a higher base every year. You know, you're not taking out that money that you've made and spending it. You're keeping it in there to accumulate and grow over time, which just adds to more and more returns. There's actually a really fun stat here that I found. So I was like, I bet you it's not fun.
I've just stopped saying that because at this point I know they're never fun.
So if you'd invested $10,000 in the S&P 500 index, so that's the top 500 companies in the US in 1960, so kind of when your grandma was investing, it would be worth $641,000 now, based just on the movements in the share price.
600, so 10,000 to 600.
Yeah. If you had, so that's assuming you've taken all those dividends out and it's just the share price movement.
Oh, so not reinvesting.
If you had kept those dividends in there and reinvested, which means you're then starting from a higher base every year, when we've got that compounding, it would be worth over $4 million. So that's how much difference reinvesting your dividends versus taking them out.
Hold on, that's $10,000.
Yeah.
And it's grown to $4 million.
Yeah. Yeah, which is wild.
We could change the future of our entire family's wealth by investing intergenerationally. Like if that portfolio that's now worth $1 million, if Dad continued to invest it in the same way, passed it on to me, my sister and my brother, and we did the same thing, and then it's done for their kids and their kids.
Totally.
Can you imagine?
Yeah, but it just goes to show though, like it's even like if you're investing yourself in your sharesies and your money grew a little bit one year and then you're like, okay, I'm going to take some of that money out. That's effectively a dividend that you're paying yourself, you know? So if you were like, look, cool, I've made $1,000, I'm going to take that out. You're then starting from a lower base.
Well, I mean, I've done that recently, but I've done it because I've had to.
Yes. No, but I'm meaning like this is kind of essentially if you take money out or you take dividends, it's kind of the same concept. You're still taking money out of your investments, so you're not keeping it in there, so it's not growing by as much.
It's kind of, I reckon, every time you say it, I don't know why this is what I think, but I'm thinking of a big pyramid, a big sand pyramid.
Scoop off the top.
And we're scooping the top off, you know? That's what it feels like.
Yeah.
It's like the dust storm is coming.
Yeah.
It will keep going.
And then the dust comes back and builds that up.
And then you're pulling it off.
But if you didn't take it off, it would be a bigger pyramid.
Yeah, exactly.
Yeah. That's kind of, I guess, an interesting way to look at it. But yes.
My brain is weird.
And then the last takeaway, so she was very diversified. She invested in really boring companies that she knew, invested in dividend-paying companies, and she invested for the long term, which we've kind of already touched on. And, you know, she kept in there 50 years, which is absolutely bananas. And, yeah, I think it just goes to show the longer that you can invest for, the bigger your gains because the stock market goes up over the long term. Yeah.
So what about in this situation? Because I've been talking to Dad about this because I know that because the money I think now he can move to a managed fund or something. I'm not really sure. He's looking at the options of moving it into maybe some different investments.
Yeah.
I know this is no advice. However, in that situation, you're saying leave it in there. If it was to be moved to different investments because it looked like maybe Woolworths was just like, I don't know, not the best investment or whatever, and it was moved somewhere else, is that still the same concept as leaving it in?
Yeah, I think you're still keeping it invested. Yes, you're selling out of one thing and putting in another, but as long as you keep it invested, the only thing with managed funds is they have additional fees on them. But yeah.
I just more meant the idea of moving the money into different investments. It's still this. That's a good idea if you think that other investments are going to be better than whatever you've
got. Yeah, that's the whole point of when you're looking at what to invest in. It's like the trade-off of, okay, do I keep the money in this company or fund, or do I invest it, or do I transfer it or invest and put the money in something else that might do better? And that's what I was doing every day when I was managing money. It's like, okay, this is the portfolio, but can I find something better? And if so, then of course do that.
Yeah.
But yeah, there's that famous saying of it's time in the market more than timing the market. So whatever you do, don't take the money out and wait around until you find something else to invest. You keep the money invested and keep it growing over that time is probably the most important thing. And if you don't know what to invest in, just invest in the index.
It's better than doing nothing.
Yeah, like we said, it's delivered 8% return over the long term. So,
which is still amazing.
Which is amazing. Yeah, way better than what you're getting in the bank. So do it.
Do it. Yeah. Just do it. What's that song?
Do it, lick it nice. Isn't
lick it good. Something just like you should. Yes.
My neck, my back, my pussy.
Is that the song?
Wow.
It totally is.
Wow, we're talking about your grandma to pussies and crack.
It was just such a classy portfolio. I mean, classy episode.
Should be rolling in a grave.
Sorry, Debbie. Sorry.
But
we'll
yes.
keep it above board.
But I think this is a really cool way as well to get you, your dad, your family interested in investing.
Yeah.
Like how cool would it be if I could leave a portfolio to my grandkids and get them interested in investing and show them how easy it is to grow wealth over generations and create this kind of family legacy. Is quite awesome and quite cool.
It's amazing. I think maybe I need to call a family meeting. Just be like, guys, this is the situation. How amazing is she?
Yeah.
Let's not F it up.
And also let's not get some rogue uncle or auntie that's like, let's sell it all.
Oh, yeah. No. Oh my God.
That would be the worst. It's like you build up this legacy and this like wealth, and then you just get someone that makes a really shitty decision. And yeah. But I also think from this, like, another thing is you don't have to pick all the best stocks. Do you know what I mean? I think
I definitely get decision paralysis sometimes. Yeah, I'm like, but I want to choose the best one.
Exactly. And you're kind of farting around trying to find a really, really good one. And it's like,
just pick one.
Just invest. If you invest in 50 years, you'll be fine. So it's just invest. Stop pissing about trying to find the best stocks.
Listen to Auntie Witch.
Yeah. Yes. So yes, that's what
I loved that
Yeah.
episode. And I just think it was meant to be that we started the curve.
Yeah.
The title could be My Grandma's $1 Million Portfolio.
Yes. And FMA, please don't at us.
Yeah, no.
This is, she's dead.
We love her and we're just proud.
Yeah.
We're not trying to tell people to go and do what she did.
Please don't invest in what she's invested in.
No. Caveat. But it's a really, really good example to look at how much that $12,000 grew to $1 million. I'm sorry.
That's crazy, yeah.
If you're not going to invest after knowing that, then you may as well just not listen to this podcast anymore, I think.
And the key takeaways, have a diversified portfolio, invest in those boring companies or companies invest in companies with dividends because they're pretty financially sound, and invest for the long term.
Yep.
Do it. So you've got to the end. Well done.
Congrats. Now, how many people skipped through?
This is the carrot that we've just dangled.
Okay, this is very exciting. So there's 100 spots for you to join the world's biggest investing club. Next week, we are going to be notifying everyone on the waitlist. So if you would like to join the waitlist and make sure that you don't miss out, then we've put a link in the podcast show notes.
So these spots are for people who are immediate investors, aren't they, Soph?
Yeah.
What would you classify as an immediate investor?
I would say it's people who understand
the basics.
So things like diversification. If someone said that, you don't need a big elaborate explanation.
Someone that's kind of been with the curve since the beginning, or they've listened to a lot of episodes.
They maybe have done a course.
Yeah. That's what we consider as kind of an immediate investor. Or you might be investing, but you're like, I know I could be doing more with it, or I don't really know what to invest in. You want some ideas. So that would be the kind of person.
Yeah. The reason we're limiting it right now is just because at the moment it's founding members. There's a lot of content in there. There's some really exciting tools and things that you can definitely use, but you're also going to be a part of what this evolves into. So,
but also if you're a beginner investor and listening, don't worry. We've got something coming for you in the pipeline as well, but we don't want you to jump in there and be overwhelmed. So that's why we've kind of segmented different target audiences for this.
And even if you want to have a look, we've put the link in the podcast show notes. It'll link you straight to our website where you can see all the details. You can have a peruse. So we'll link that. But we'll see a bunch of you in the club, and for the other ones that are feeling a bit left out, don't worry. We're hustling. We're getting our A into G. There'll be a whole lot more so that if you're a beginner investor, you can join very soon.
Thank you so much for listening to Raising the Curve. These conversations are designed to teach you everything you need to know to be better with your money, from saving to investing to talking with your friends about your salaries, all of that stuff.
And if you like what you heard, we would love if you could please hit subscribe wherever you're listening and leave a comment. Let us know what you thought about the episode.
And it only takes 1 second and it would really make our week, our month, our year.
Yeah.
So please do it. Okay. Love you.
Bye.
Bye.